Welcome to Oregon Cash Flow Pro. My name is James Barber, and I am always here to help you maximize your cash flow. Today's discussion, we're going to do a deeper dive into 529 plans and in relation to cash value life insurance, prompted by a discussion that I think is warranted based on a great comment that somebody left on our last video talking about 529 plan versus whole life insurance. And I think that it warranted a more in-depth discussion. So let's hop over to that comment first, and then we'll go into more detail on these things. Here's the comment. Let me preface this conversation by saying I am not usually a do this or do that type of advisor. Most of the time, there's good reasons to diversify in our efforts, where we're putting our money and where we're getting our tax savings and where we're planning on accessing funds in the future. It can usually be beneficial to take a multi-targeted approach as opposed to saying you should do this or you should do that. Now, the original conversation was between thoughts on 529s versus whole life. I gave some thoughts on both of them, but I did kind of present it in a way that was one or the other. Although we did mention taking advantage of some of the tax benefits of the 529, even if we're planning on mostly doing cash value life insurance. Now, let's jump into the comment and we'll dig into this further. Dallin Bunnell says, you mentioned that many people only fund a 529 for a short period, which may be true. But if it's true, then the life insurance is problematic. It takes several years for life insurance to have more money in it than you've contributed. The only benefit of the life insurance would be not being reported to FAFSA and no market risk. But again, it would need to be a long-term play anyway in the short term. Even cash in a 529 would likely end up better. Okay, I'm going to pause there and let's address the short period here. Funds in your 529 are essentially going to be at risk in the market to some extent. You could hold it in cash, but for the most part, let's assume that you're utilizing the 529 for some of the tax benefits, but also investing in the market. Now, in a short period, the market volatility is not really great for that. Let's say 5 years or less, okay? Market investments, not really ideal for that. If you're starting to save for college and you've got college coming up within 5 years, it's probably more important for you to preserve your capital as opposed to try and get excessive gains to help you fund college. Most likely, you're going to make sure that you just have essentially the same amount of cash that you've put in order to fund college. Life insurance, with a good design, takes about 5 years to break even. Some cases, it could be a little bit quicker. Some cases, slightly longer. But we're going to be very, very close if we're using life insurance, and the time frame is 5 years. Even if it's shorter than 5 years, we're going to be very close to the amount of money that we put into it that we have available in cash value with a proper design for that plan. So life insurance isn't really problematic in that case if we go under the assumption that you're basically funding the money that you're going to use for college, not relying on getting gains in order to fund college, because you're basically too late at that point. Or it becomes too risky if you're relying on gains that in an investment within 5 years in order to fund college. Doesn't mean it can't happen, but it's definitely a risky approach. So the reason I advocate for life insurance in that situation is because of the other benefits that go along with that. And we actually have the ability to utilize that policy that we've set up as a line of credit at 5% or 4.76% or some low interest rate for the rest of our lives. That's the advantage of getting that going. Now, does that mean that you have to do that then? No, I mean, you can start a life insurance policy basically anytime as long as you can qualify for the life insurance. Well, generally, the sooner you do it, the better the health rating that you're going to get, the lower your overall expenses are going to be for the life of the policy. And if this is something that you see value in owning for the rest of your life, you might as well get started with it. So from a short funding period, That is why I prefer the life insurance. There's not much advantage to putting it at risk in the market. And if we're just going to put it in cash, we don't get any of the other benefits other than whatever tax advantage we might get from our state or our local jurisdiction. Let's move on to the next part of the question. Dallin says, I definitely prefer the 529 for college-specific funding goals. What makes the 529 more attractive now than it used to is the Roth conversions. If your kid doesn't use all the money, they can move that over to a Roth IRA over the years. This could potentially help them save more elsewhere when they're starting their career. For example, he doesn't contribute to his 401k because he prioritizes the tax-free status and the flexibility of the Roth IRA. He doesn't make enough to be doing both. If he had extra funds, he could potentially be doing both. Obviously, this can only go so far, but I think it makes a lot better plan. This is a new thing that came about over the last couple of years. Might have just been this last year where they made this change. I think it was just this last year they made this change to where you could do a rollover into a Roth if the funds don't get used for education purposes. You don't have to roll it over into a Roth, but it gives you another possibility. It used to be that your alternative, if you didn't use it for education or any of the other few things that you can use a 529 for and not have to pay taxes, essentially you could give it to somebody else. You could list somebody else as the beneficiary of it so that they can use it for education purposes. Not very attractive. Possibly could be if you have more kids or you expect to have grandkids that you can assign it to. But for the most part, your funds were either getting locked up for education purposes or they're going to end up coming out and you're going to get taxed and possibly penalized. Adding the ability to be able to roll it into a Roth definitely made it more attractive. But there are restrictions around being able to roll into a Roth. We're going to look at those details. Something to realize. I should have brought this up a little bit earlier when I was talking about diversifying and utilizing different financial tools. Whether you decide to use a 529 and how much you decide to put in it and how much you decide to put in any other investment or retirement account or savings, it's going to depend on your overall financial portfolio. We're going to look at your overall financial portfolio in order to actually advise on your specific situation with what we would recommend. Do we want to put some money over here, some money over here? How much goes here? How much goes there? Where does your risk tolerance lie? What are the concerns that we have to take into account? So those are all things that we have to think about. It's not just cut and dried, use this, use that. When it comes to the benefits and where the 529 is attractive, a lot of that is going to have to do with how much do you have to contribute to it? How much do you expect to spend on education? There are some people that will just use this for funding college. For one kid, maybe multiple kids. There are other people that might use this to fund private elementary schools or private middle schools or private high schools. It could be a religious school. There are a number of places that education expenses accrue beyond just college. And so if you've got somebody that's wanting or has the ability to put just a bunch of cash into these things to help make sure that they've got some tax advantages to help them pay for their education expenses, it becomes a lot more attractive to use these features. You can fund like $300,000 into one of these accounts at the initial outset. If you're sitting on $300,000, we're definitely not talking about whether you should be putting that into a 529 or life insurance. That is not an either or situation. You're definitely going to want to look at what is your overall goals and what's going to help you best meet those goals. Certainly, you have, in that situation, you would have other funds that are invested elsewhere. And where do each of these fit in that overall plan and what gives you the best advantages, right? That's a different conversation than when we were talking about a short funding period at the beginning of this video. A short funding period where you don't have money to be able to max this thing out. And you're needing the funds that you have right now that you're going to be contributing to make sure that they're going to be there when you're ready to fund college. If you've got 300,000 to put in a 529, you probably have the ability to absorb some downside in the market and still be able to fund college. And even if the 529 plan can't cover it because the market drops, you likely have funds outside of it that can make up for it. That's a totally different situation. So we got to recognize that the discussions that we're having here are abstract. They're hypothetical situations that we're trying to identify potential issues, potential benefits, potential pros and cons of each situation so that you can help identify where to go in your scenario. Now, clearly you're going to want to speak to somebody that has some expertise in these areas, but hopefully this conversation will help to kind of narrow down or give you some additional information so that you can further dive down the rabbit hole and figure out what might work best for you. Okay, here we have a website that gives us a little bit of answers into 529s and some things to be aware of. So first, to be eligible to roll into the Roth IRA, the account has to be open for at least 15 years. The beneficiary and the Roth IRA owner have to be the same person. The rollover can't exceed the Roth IRA owner's contribution limits, such as it can't exceed their earnings for whatever year you're doing the rollover. It can't exceed applicable contribution limits. It can't exceed $35,000 in total rollover. And it can't exceed the total amount contributed to the 529 before the 5-year period prior to the rollover. Okay, so let's talk about these a little bit. The beneficiary is who the 529 is listed as being the beneficiary of. Like they're actually the owner of the policy. Let's switch over to this one really quick so we can get just a little bit more information about the 529s. And then we'll step back to the Roth discussion. This is an Investopedia article, really detailed. A lot of good information in here. Essentially, you have two types of 529 plans. You have your education savings plan and prepaid tuition plans. Prepaid tuition plans, you could potentially lock in current tuition rates. That's a pretty good deal. There's a big plus for utilizing a 529 if it gives you the ability to lock in today's rates. Note, anyone can open a 529 account, but parents or grandparents typically establish them on behalf of a child or grandchild. That part is important, depending on what you're trying to do with it and the rollover rules. Essentially, there could be, from what I've been looking at, there could be some advantages to opening it in your own name, letting the account grow there, and then you just change the beneficiary when you're ready to fund college or shortly before you're ready to fund college. You could change the beneficiary to the person who's going to need it at that time. Now that part is subject to potential changes because basically the IRS hasn't ruled on whether changing beneficiaries might reset that 15-year rule or the 5-year rule. Essentially, this is kind of a wait and see when it comes to changing the beneficiaries and what you may or may not be able to do with it if you're not using it for education purposes. 529s were expanded to include registered apprenticeship program expenses and up to $10,000 in student loan debt repayment for account beneficiaries and their siblings. So that's a nice change. Currently, more than 30 states provide tax deductions or credits of varying amounts for your 529 contributions. You likely need to invest in your home state's 529 in order to take advantage of those state deductions or credits. You can utilize the gift tax exemption to help fund these things. And it even says that you can contribute up to 5 years worth of annual gift tax exclusions in a single lump sum without triggering gift tax consequences. A 529 plan is technically a custodial account. So an adult custodian controls the funds for the benefit of a minor. This is assuming the beneficiary is the child. The beneficiary can assume control over the 529 once they turn 18. That's how a custodial account works. You might not want that. And that's where I was referencing having you be the owner and then you transfer as needed to another person's account. Here's your transferability rules. The owner may transfer funds to another plan once per year unless a beneficiary change is involved. You are not required to change plans to change beneficiaries. You may transfer the plan to another family member who is defined as one of the following. And there's the list. So this is interesting. The owner may transfer funds to another plan unless a beneficiary change is involved. So you could open a plan on you could open a plan on your kids, and then just transfer the funds into one of the kids' plans when you're ready to fund it for them once per year. So clearly you're going to do this ahead of time if you have multiple kids and you're going to transfer funds to cover multiple years of college. Here's your list of qualified expenses. Now back to the 529 limitations around the rollover to the Roth. Some things to consider. With the contributions being subject to Roth IRA limits, that's currently $7,000 per year. You have a total of $35,000 that you can roll over into a Roth, period. And if the account is your kids, they have to be able to have earnings in order to be able to roll it into a Roth. If you're the beneficiary, you may have to worry about the income limits on rolling into a Roth. So you might not be able to roll it into a Roth at all. And then we have that 5-year prior that we have to worry about. We're not going to be able to do a rollover if we haven't contributed anything prior to the 5-year period where you do the rollover. So this can get complicated pretty quickly when it comes to optimizing this stuff. It doesn't mean that it can't happen or you can't figure out a way to do it, especially if you can get some good financial advice. And then take note of this specifically for Utah taxpayers, but I imagine this may apply to other states. If you're getting a credit and you end up getting that tax deduction, but then you do a rollover to a Roth, you might have to adjust your returns and add that amount back into your taxes. So back to the comment at hand, there's definitely situations where the 529 could be a good place to put money. I don't think that negates utilizing a cash value life insurance policy for some of these things, in addition to what we're doing inside of a 529 plan, or even in place of it in some situations like the short funding period that we talked about. So I had a lot of things in my head when I saw this comment, and I hope I got to them all during this response video. When I go to edit this thing, I'm going to probably see that I maybe missed some things, but if you have any questions or comments or you want to continue this conversation, put those in the comment section below, because I do appreciate where these conversations go in helping us to do a little bit deeper dive into some of the possibilities and the things that we can do with our finances.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.